In the 1970s, a guy named Jack Bogle, the founder of Vanguard, had a simple idea. Don't try to beat the market. Own it. Keep costs low. Stay diversified. That idea built more real-world wealth than almost anything else in investing. You can still use that philosophy today. But what if you took Bogle's original idea, modernized it for today's market, and turned it into the best 3 ETF portfolio on the planet? In this video, I'll break down exactly how that portfolio works. We'll look at why the original structure made sense, where it falls short today, and how a modern version keeps the simplicity while improving results. And at the end, I'll show you how this modernized 3 ETF portfolio can turn a simple $10 a day investment into a $1.5 million portfolio over time. Before we talk about what to do going forward, we need to talk about what most people have been doing for decades. The classic 3-part portfolio was built around a simple idea. Spread your money across US stocks, international stocks, and bonds. Typically, that meant the majority went into US companies with smaller but equal portions allocated to foreign markets and bonds. The goal was balance. Stocks drove growth, international exposure added diversification, and bonds acted as a shock absorber when markets turned rough. For a long time, this structure made a lot of sense. Bonds paid meaningful income, international markets moved more independently, and volatility felt easier to manage with fixed income in the mix. The portfolio didn't try to be clever. It focused on staying invested, keeping costs low, and avoiding emotional decision-making. That philosophy is still powerful today. What's changed is the environment those ideas were built for. Bonds don't do what they used to. Over long stretches, their ability to grow purchasing power has dropped. At the same time, global markets have become far more interconnected. Many of the largest companies already operate worldwide, reducing the diversification benefit that international allocations used to provide on their own. That's why the portfolio needed to evolve. The new Boglehead's portfolio structure remains familiar, but it has been adjusted to reflect how markets actually behave today. Stocks remain the engine of growth, but the emphasis is more intentional. Bonds are still present, not for performance, but for stability and flexibility. International exposure is streamlined, complementing growth rather than diluting it. The key difference isn't complexity, it's efficiency. The new allocation accepts that long-term wealth is built through sustained exposure to growth, while still respecting risk. It preserves the spirit of the original approach while updating the execution, aligning the portfolio with modern market realities and long-term compounding, rather than outdated assumptions. Now let's talk about the even more modernized version, the one built for this year and beyond. The goal is still the same as the original 3-fund idea. Keep it simple, keep it diversified, and make it easy to stick with for decades. The difference is we're updating the ingredients so the portfolio fits how the market works today. The original portfolio had 3 roles. Growth came from stocks, diversification came from international exposure, stability came from bonds. That framework still makes sense. What's changed is how well those tools still work. The foundation stays the same. Broad US stocks remain the core because that's still where long-term growth comes from. Owning the market instead of trying to beat it is just as powerful today as it was when Bogle introduced it. The stabilizing piece is where the first upgrade happens. In the Boglehead's portfolio, bonds were there to reduce volatility and provide income. Today, bonds don't serve that role nearly as well over long periods. So instead of fixed income, the modernized portfolio uses high-quality dividend-paying companies to do the same job. They still provide cash flow and stability, but they also participate in growth, which bonds increasingly struggle to do. The growth piece is the second upgrade. The traditional portfolio spread growth across US and international markets, but global companies now operate everywhere, and the biggest drivers of growth are concentrated in specific parts of the market. The modernized portfolio reflects that by carving out a defined allocation to higher growth sectors, rather than diluting growth across regions that often move together. So each piece still maps back to Bogle's original structure. Growth, stability, and diversification are all still present. The difference is that each role is filled with tools that fit today's market instead of yesterday's assumptions. That's what turns a classic 3-fund idea into a modern 3 ETF portfolio, and it sets up the rules that make this approach actually work in real life. In a couple of minutes, I'll show you the 3 ETFs that make up the modernized portfolio, and by the end, you'll see how this setup can turn a simple $10 a day investment into a portfolio projected to reach around $1.5 million over time. But before going any further, there's something most people skip, and it's usually why good portfolios fail in real life. ETFs don't make you money on their own. The way you use them does. That's where these 3 rules come in. The first rule is simple. Pick one ETF for each role. One foundation, one income stabilizer, one growth driver. When people start stacking multiple funds that all do the same thing, they're not diversifying. They're just creating overlap and confusion. This portfolio works because each piece has a clear job and stays in its lane. The second rule is figuring out your goal before you invest. Are you building long-term wealth, future income, or both? This portfolio is designed for people who want long-term growth first, with income developing along the way. The third rule is consistency, and honestly, this one matters more than everything else combined. You don't need perfect timing, you don't need predictions, you need repeatable behavior. Investing the same way, month after month, through good markets and bad ones, is what turns an average strategy into an exceptional outcome. And this is where things get tested. Because consistency feels easy when markets are rising, it gets much harder when prices fall, which is exactly why it helps to understand what happens when the market drops and how this portfolio is built to get through those periods. At some point, the market will drop. That's not a prediction, it's history. Over the last century, the market has gone through crashes, recessions, bear markets, and corrections more times than most people can count. And yet, over long periods, it has continued to move higher. That's how compounding works when productivity and innovation keep pushing forward. Market drops feel intense in the moment, but they're a normal part of the process. 1-year declines happen often. 5-year declines are far less common. 10-year periods where the broad market is still down are rare. The longer your time horizon gets, the smaller the chance becomes that a temporary drop turns into permanent damage. This portfolio is built around that reality. The foundation moves with the market, which means you feel downturns, but you also participate fully when the recovery happens. And that matters because some of the market's strongest days tend to show up right after the worst ones. Missing those days can do real damage to long-term results. The income portion plays a critical role during downturns. Even when prices fall, cash continues to come in. That money can be reinvested at lower prices, increasing the number of shares you own without forcing you to make an emotional decision. You keep investing while everything is cheaper, automatically. The growth portion will be the most volatile, and that's by design. Volatility is the cost of higher long-term returns. The key is that it's contained. It accelerates recoveries without overwhelming the portfolio. The real risk isn't market declines, it's panic. This portfolio isn't designed to dodge downturns. It's designed to make it through them because staying invested through those periods is what allows compounding to do the real work over time. Now, let's look at the specific ETFs that make up the modernized portfolio, starting with the foundation. This is the core holding, the one everything else is built around, and this role is filled by the Vanguard Total Stock Market Index Fund ETF, or VTI. VTI is anchored by broad equity exposure designed to track the overall performance of the U.S. stock market through a single diversified allocation. This approach prioritizes market participation over prediction, allowing long-term growth to be driven by the collective performance of thousands of companies rather than selective positioning or tactical decisions. As the foundational component of the portfolio, it establishes structural stability while remaining fully aligned with long-term capital appreciation. From an institutional participation standpoint, the data shows strong, sustained engagement. Current institutional ownership stands at 28.92%. Over the last 12 months, more than 2,600 institutional buyers added to their positions, while about 2,000 reduced or exited. That difference matters. During the same period, roughly $105 billion flowed into the fund, compared to about $12 billion flowing out. That tells you this ETF is being used as a long-term holding, not a short-term trade. That pattern hasn't changed recently. Looking at quarterly activity, institutions kept buying more than they sold through 2024 and into 2025. Even in the most recent quarter, about $349 million came in, while roughly $155 million went out. Money continues to move in, not away. Analyst expectations line up with that behavior. VTI carries a moderate buy rating based on a mix of buy and hold opinions, with no sell ratings at all. The average price target sits around $342, with very little disagreement between high and low estimates. That kind of consensus usually points to steady, not speculative forward performance. There's also very little pressure betting against it. Short interest is extremely low, at about 0.2% of shares outstanding. Even though short interest ticked up slightly month to month, it would still take less than 1 day of normal trading volume to cover those positions. In plain terms, very few investors are betting on a major decline here. Liquidity is another reason this works so well as a foundation. VTI has about 1.7 billion shares outstanding and trades over 7 million shares per day on average. Recent trading volume has stayed close to that level, which tells you that buying and selling happen smoothly without stress or distortion. Performance history supports its role as a long-term engine. Over the past year, returns have been around 16%. Over 5 years, total growth is about 72%. Over 10 years, the fund has grown more than 250%. That's the power of broad market exposure compounding over multiple cycles. These figures show the compounding effect of holding broad equity exposure across multiple market cycles. Income isn't the main goal here, but it's still part of the picture. VTI currently yields about 1.1%. Dividend growth has averaged a little over 6% per year over the past decade, and the fund has paid dividends for more than 2 decades straight. It's not designed to maximize income, but it contributes steadily to total return. From a structural perspective, the holdings data confirm broad diversification. The portfolio spans 3,541 total holdings, with sector exposure spread across technology, financials, consumer sectors, healthcare, industrials, and other areas, and only 0.41% held in cash equivalents. No single holding controls the outcome, which is exactly what you want from a foundation. This is why VTI sits at the center of the portfolio. It captures growth wherever it shows up, participates fully in recoveries, and compounds over time without requiring constant decisions. But growth alone doesn't keep people invested through rough markets. For that, the portfolio needs stability and cash flow, which brings us to the next piece, which is the Schwab US Dividend Equity ETF, or SCHD for short. After this, I'll show you the final ETF that completes the modernized 3-ETF portfolio, and by the end, you'll see how this setup can turn a simple $10 a day investment into a portfolio projected to reach around $1.5 million over time. But before we get there, let's look at the second piece, SCHD. In the original Bogle portfolio, bonds were there to provide income and reduce volatility. That role still matters. What's changed is the tool. SCHD steps into that same role, but instead of lending money like bonds do, it owns profitable companies that consistently pay dividends. You're still getting cash flow and stability, but you're staying fully invested in equities. You can see how this is used by looking at institutional behavior. Over the last year, about 1,800 institutions added to SCHD, while roughly 1,000 reduced or exited. That difference led to around $18.3 billion flowing into the fund, compared to just over $4 billion flowing out. That kind of imbalance tells you that this isn't being treated as a trade, it's being treated as a long-term stabilizer. Looking across multiple quarters from 2022 through 2025, the pattern stays consistent, with buying picking up during periods of market stress. That's exactly when you want this piece to do its job. Analyst sentiment lines up with that behavior. SCHD carries an overall hold rating based on hundreds of analyst opinions covering most of the portfolio. There's no extreme optimism and no heavy pessimism. Price targets are tightly grouped around $28.90, which tells you expectations are steady and grounded. That kind of tight clustering signals low disagreement and fairly clear expectations about value. That shows up again when you look at positioning. Short interest is extremely low, at about 0.16% of shares outstanding, and it's been falling month to month. At current trading volume, it would take less than half a day to cover all short positions. In simple terms, very few investors are betting against this fund. Liquidity is deep, with about 2.6 billion shares outstanding and close to 21 million shares trading daily. Buying and selling happen smoothly, even when markets are under pressure. Income is where SCHD really earns its place. Right now, it yields about 3.62%, well above the average equity ETF. More important than the yield is how that income grows. Dividend growth has averaged just over 7% per year over the past 3 years, more than 9% over 5 years, and over 10% annually across a full decade. On top of that, the fund has delivered 14 straight years of dividend payments and 14 straight years of dividend growth. That kind of consistency gives you cash flow you can plan around. Performance lines up with that goal. Over the past year, the total return is just under 4%. Over 5 years, it's about 31%. Over 10 years, roughly 137%. These aren't growth numbers, and they're not meant to be. This piece is here to compound steadily while supporting the rest of the portfolio. Costs stay low at 0.06%, assets under management sit around $76 billion, and the fund has the scale to operate smoothly in all market conditions. Finally, the internal structure supports everything you've just seen. The portfolio holds 102 positions, spread across sectors that tend to generate cash rather than chase trends. The top 10 holdings make up about 41% of the fund, which strikes a balance between focus and diversification. This is why SCHD replaces bonds here. It provides income, helps manage volatility, and supports behavior when markets get uncomfortable, without stepping away from growth entirely. With that stability in place, the portfolio can afford to lean into its final piece, the one designed to push long-term growth further. And for that, I have added the Vanguard Information Technology Index Fund ETF, or VGT for short. VGT exists for one reason: growth. Not short-term excitement, not income, not balance. Its job is to concentrate exposure in the part of the market that has driven productivity, innovation, and long-term expansion more than any other: technology. By keeping this exposure in a defined slice of the portfolio, you get the upside without letting it dominate everything else. You can see how professionals treat this ETF by looking at capital flows. Over the past 12 months, about 1,360 institutions added to VGT, while just under 1,000 reduced or exited. That translated into roughly $10.3 billion flowing into the fund, compared to about $4.3 billion flowing out. Quarter after quarter through 2024 and into 2025, inflows continued to outpace outflows, even during volatile stretches. That tells you large investors aren't abandoning growth when things get uncomfortable. They're sizing it appropriately and staying invested. Analyst sentiment lines up with that picture. VGT holds a moderate buy rating based on more than 800 analyst opinions covering about 72% of the portfolio. Most ratings cluster around buy, moderate buy, and hold, with only one negative view. Price targets sit tightly around $759, which suggests shared expectations rather than wild disagreement. Market positioning reinforces that. Short interest is extremely low considering a growth-focused ETF, with only about 0.23% of shares sold short. That figure has been declining month over month, and at normal trading volume, all short positions could be covered in less than a day. In simple terms, very few investors are betting against this ETF. Liquidity is solid, with nearly 150 million shares outstanding and more than 500,000 shares trading daily. Performance history clearly illustrates why VGT replaces traditional growth allocations like international equities. Over the last year, VGT returned about 23%. Over 5 years, it's up roughly 114%. Over 10 years, total growth exceeds 650%. These returns dwarf broader market averages and highlight the compounding power of concentrated technology exposure. From an income standpoint, VGT is intentionally weak, and that is by design. The ETF carries a 0.4% dividend yield, earning a dividend yield grade of F. Sector and holdings data confirm VGT's pure growth focus. The portfolio is 98.26% allocated to technology, with negligible exposure elsewhere. The top holdings include companies like Nvidia, Apple, Microsoft, and Broadcom. In total, the fund holds over 300 companies, so while the sector focus is narrow, the exposure within that sector is still diversified. This is why VGT replaces traditional growth allocations like standalone international funds in this portfolio. Global growth is increasingly driven by technology, and many of these companies already earn revenue all over the world. Instead of spreading growth thinly across regions that often move together, this allocation concentrates it where long-term expansion has actually shown up. When you step back, the structure becomes easy to see. VTI handles broad market growth. SCHD adds income and stability so you can stay invested when things get uncomfortable. VGT pushes growth further without taking over the whole portfolio. 3 roles, 3 ETFs, nothing extra. Together they form a simple but modernized system that's built to compound over decades, which makes it easier to understand how the full portfolio fits together. Here's how it comes together. Half of the portfolio sits in a broad US market ETF. That's the foundation. This piece captures overall economic growth through diversification, not prediction. It currently produces about a 1.1% dividend yield, with dividends growing at roughly 6.16% per year over the past decade. On the growth side, it has delivered about 13.73% average annual price appreciation. This is the engine that moves the portfolio forward over time. 30% goes into the income and stability piece. This is the bond replacement. Instead of fixed income, this portion stays in equities but focuses on companies that pay and grow dividends. It brings in a much higher 3.62% yield, with dividend growth averaging about 9.15% per year. Price appreciation has averaged around 9.31% annually, which means you're not giving up growth just to get income. This slice helps smooth the ride and supports behavior when markets get rough. The remaining 20% is allocated to the growth accelerator. This is the intentional tilt. Income here is minimal, with a 0.4% yield and modest dividend growth because cash is being reinvested for expansion instead of paid out. What you get in return is growth. This portion has delivered roughly 22.8% average annual price appreciation, giving the portfolio extra lift over long periods without letting volatility run the show. Together, the portfolio delivers a blended 1.72% dividend yield, 6.18% long-term dividend growth, and 14.22% average annual price appreciation, balancing income, stability, and long-term compounding in a simple structure. Now, let's see how this portfolio is projected to perform over the years. Let's say you invest $10 a day into this portfolio and reinvest every dividend. By the end of the first year, you would have invested about $3,650. By year 10, the portfolio is projected to be valued at around $75,000. At that stage, dividend income is projected to reach about $1,000 per year, and reinvestment starts to make a noticeable difference as the portfolio begins contributing to its own growth. By year 20, projections show the portfolio valued near $370,000. Annual dividend income is projected to move toward $1,500, and growth is no longer driven mainly by new contributions. The existing capital is now doing most of the work. By year 30, the projections place the portfolio value at close to $1.5 million. Annual dividend income is projected to rise toward $2,000, and the majority of the total value comes from years of reinvestment and compounded growth rather than daily deposits. This is where the power of the structure shows up. Nothing about the strategy changes over time. The only difference is scale. As the portfolio grows, each dollar has more room to work, which is why long-term consistency ends up mattering far more than the size of the initial investment. Want to know how to make $6,000 a month in dividends with just $25 a week? Click the video on screen to find out.